Right. Good evening, everyone. We can start with the class. Okay, let's start with the class. Let me just admit other guys here. Right. Today we're going to look at accounting for investment in associates. Remember, in our previous class, we had to do subsidiaries. So today we are going to look at a different standard, which is International Accounting Standard 28, accounting for investment in associates. Right. So I want you guys to notice the difference between AIS 28 and International Financial Reporting Standard 10, so that when you are answering your questions, then you know how to treat these two standards. Right. When we look at investment in associate, we are looking at a situation where the investor does not control the associate. They only have significant influence, which means they don't control, but they can have influence over the decisions that the associate take. So in this case, it means they don't have control. So since they don't have control, they also don't have, when we do our consolidation, we don't combine the assets. What we only account is the investment that was made by the investor in the associate. So that's another difference that you guys, when you are answering your question, which means instead of, remember, International Financial Reporting Standard 10, we use the acquisition method, where we have a subsidiary and a parent, that is International Financial Reporting Standard 10. So in International International Accounting Standard 28, we use the equity method. So in the equity method, the difference between these two is that the acquisition method will include all the assets and liabilities of the subsidiary when we do our consolidation. Whereas here in the equity method, we only include that portion of the investment which was done by the investor in the associate. So that's the difference between these two standards. So you should always look for this when you are answering your question. And most of your questions will be, they will combine the acquisition method and the equity method. So which means you should look for the acquisition and then also look for the equity method. So in that case, how do you differentiate that this is the acquisition method? In the acquisition method, you are going to have a subsidiary. So which means you are looking at a parent and a subsidiary in the acquisition method. But in the equity method, you are only going to have an investment in the associate. Right. So that's basically the difference between the two. So let's look at what significant influence has, which means here they only have powers to participate. They don't control. They only have powers to participate in the operational decisions of the associate. They don't have control or joint control. So which means they only have to participate but they don't control anything there. So that's a significant influence. Then the most important part that you guys must look at now is here, the investment in the associate. How do we measure the investment in the associate? This is the initial measurement of the investment in the associate. So what you are looking at here when we talk of measurement of the investment, it means we are looking at the value of the investment in the associate. So let's look at how do we come to the value of the investment in the associate. We use the equity method to measure the investment in the associate. So in the equity method, when you are using the equity method, you come here. The investment is initially recognized at cost, which means you go to the cost of the investment, you take that cost of the investment. Remember, the cost of the investment is the consideration which was paid. So on that consideration which was paid by the investor, then you look at anything that is gonna increase or decrease this cost in the investment. What are those items that can increase or decrease? The first is the share of profit and losses of associate after acquisition. So which means in your cost of the investment, you are going to add profit or a loss, which means if it is a loss, it is going to reduce this investment. So your starting point is the cost of the investment. Then once you have the cost of the investment, then you need now to look, was there a profit since acquisition? Then that profit must now be shared. Then for the year, which means the profit for the year must also be shared. So which means here it's going to be what is in the retained earning. What is in the retained earning, that's what you share. Remember, anything that was earned after acquisition to the beginning of the current year, it will be in the retained earning. So you need to check in the retained earning if there was profit or loss since acquisition. Then you adjust the consideration, which is the cost of the investment. Then here, you look at the profit for the year. Profit for the year. So in the profit for the year, you are also going to share between to come to this investment in the associate. You are also going to share the profit for the year. So which means the profit, the share of profit for the year is going to increase the investment in the associate. Then dividends. If there is any dividends received from the associate, remember dividends we eliminate. So which means you are going to reduce the investment by the amount of the dividends which were received by the investor from the associate. Then if there is any unrealized intra-group profits, then you have also to eliminate. Then your final answer now will be the investment in associate. So you will have your investment in the associate as your final answer. So when you are doing investment in associate, you only need to do the calculations for the investment in the associate and the share of profit. Right, so this is how you calculate your investment in the associate. This is very important when you are answering a question. And when you are answering your questions, you should be able to see whether is an investment in associate or it's an investment in a subsidiary.
Ndofaka lo nyama kweso skaftini.
Sorry,
Uyifaka apha phezulu.
can you please mute yourself, please? Right, so that's there. I think we're going to look at a long question, which is going to clarify everything. So let's look at goodwill. Remember, we can have goodwill or gain on bargain purchase. I think you guys by now, this does not change. But the only difference now is if you are doing investment in associate, your goodwill is not, you are not going to take it separately in the statement of financial position. It will be in the carrying amount of the investment. So you don't need to separate it from the investment. It will be in the carrying amount of the investment. Remember, goodwill is going to be value of equity, and you compare it with consideration. So if there is goodwill, it means you got your goodwill by the difference between the consideration and the value of equity. So it means it will be here in this consideration or the cost of the investment. So there is no need to separate it when you want to determine the investment in the associate, because already it's in this amount, the consideration. You can calculate it, but when you go to your statement of financial position, there is no need to separate it. It will be here in this consideration. Then we have also a gain. If there is a gain, remember when we have a gain, it means the value of equity is more than the consideration. So that gain on bargain purchase is now going to increase your share of profit of associate. So which means here, you should include it under this line. It was supposed to be here again. If there is a gain on bargain purchase, then it means it has to increase this investment in the associate. So you have to add it to increase the investment in the associate if there is any gain on bargain purchase. Right, so let's look at this small example and see what they want us to do. They say on 1 July 2016, Prit Limited acquire a 30% interest in the equity share capital of LAC Limited for 24,000. This is the cost of the investment. When the retained earning of LAC were 61,000, the share capital consists of 10,000 shares amounting to 10,000. On this date, the land of Lucky was revalued with 5,000 above the original carrying amount. Prit Limited had significant influence over Lucky since 1 July 20. What is this? 1 July 20-3. Right, so they had significant influence. So if they have significant influence, what does the question requires us to do? They say, calculate the goodwill at acquisition of the investment in LAC Limited. Let's not ignore the tax implication. Let's do this one, including the tax implication on the revaluation of land. Right, when you are doing your investment in associate, you can choose not to do the analysis. You can also do the analysis. There is 2 ways you can do your calculation. Remember, I said calculations are not compulsory that you should do the analysis. So if you have a short way of doing the calculation, you can still use that one. So when you are answering your questions on investment in associate, there is no, you can use the analysis or not. Depends on which way you are familiar with. Right, so let's do this calculation for goodwill without using the analysis. I want you guys, when you go to the exam, so that you can be able to quickly calculate the goodwill, because sometimes you might find that you are going to do the analysis for the sake of calculating goodwill, while there is a way you can calculate goodwill. Remember, the analysis is very long. So if in your answering you only want to evaluate the goodwill, then it means you can do the calculation without doing the analysis. Right, so let's see how do we do it. How do we calculate the goodwill without using the analysis? Let's see if, right, so which means we're going to have 30% significance influence. So what we just need here is the share capital and the retained earning, and the revalued land, as we want to use tax implication. So which means we are going to have share capital. The share capital is 10,000. Then the retained earning, it's it's 61,000 as per our question. Then revaluation. The revaluation is 5,000. We say we want to do the tax implication, so which means we should apply capital gain tax. Remember, all non-depreciable assets, we should apply capital gain tax. So which means we are going to have 5,000. Let's use the percentage or the tax they use. What do they say is the tax rate here? We can use 27, it's still fine. So we're going to have 5,000 times 80% times 27%. Right, so this is going to be our deferred tax. So this is going to be our deferred tax. So which means how much are we going to have as our deferred tax here? Are you guys there? So our deferred tax is going to be 1,080. So this one is the deferred tax. So let's have our revaluation. Full amount, which is 5,000. Right, so that's everything that we have. So this is going to give us the total net assets. How much net assets are we going to have? It's 10,000 plus 61,000 plus 5,000 minus the net assets. Anyone who got the figure for the net assets?
Oh, 74,920.
74,920. Right, when we have your net assets here, you see here we're taking the full figures. When you have your net assets, remember we want to calculate goodwill without using the analysis. So when you have your net assets, you go and look at the interest. What is the interest in this associate? So that you determine the value of consideration, the value of equity, which was purchased. So you are now going to look at the interest in the associate. So it's going to be 30% of this figure times 74,920. That is going to be the interest. How much are we going to have? We just multiply by 30%. So this one is going to be 22,476. That's the interest, which means this is the value of equity which was purchased, 22,476. Then when you have the value of equity, then you go now and look at the cost of the investment. Cost of investment. The cost of the investment in our question is 24,000. So you can see here, we have goodwill. The cost of the investment is more than the equity which was purchased. So there is going to be goodwill here. So that's the goodwill that we are going to have here. How much is going to be the goodwill minus 24,000? 1,524. So this is how you calculate your goodwill if you don't want to use the analysis. These are if it was gain on purchase, it means the cost of the investment must be less than the value of equity which was purchased. It will be vice versa here. Then you know you have what? Gain on purchase. So this is how you calculate your goodwill if you don't want to use the analysis. Remember I said investment in associate, you can use the analysis, but sometimes the analysis can take your time for the sake of calculating goodwill. So you must find a way to calculate goodwill without doing the analysis of owner's equity. Right, so that's how you, another alternative for calculating goodwill. Right, any question before we move to the next part? If there is anyone who need clarification on this goodwill. Right, if there is no one, let's look at unrealized intra-group profits and losses. I want us to look at this carefully. Right, remember in International Financial Reporting Standard, there's something that is missing here. Okay, I think they included them here, okay? Right, in International Financial Reporting Standard 10, we used to say eliminate common items. All intra-group transactions, we were eliminating them when we are using International Financial Reporting Standard 10. We eliminate all common items. But when you are using AIS 28, you only eliminate unrealized profits and losses only. So which means all other intra-group transactions which are not unrealized profits and losses, you leave them as they are. You only take account of unrealized profits and losses only. So if there is a line item where there was a sale between the investor and the associate, and that profit is not yet been realized, that's the only item that you are going to eliminate. Things like interest received or paid, management fees, intra-group loans, those ones are not part of AIS 28. So the loans, the interest whatsoever, as long as it is not an unrealized profit or loss, then it means you don't do anything with it. So that's another key area that we should look at when we are answering our question. When we do our elimination, we only eliminate unrealized profits and losses only. These management fees, all these between the associate and the investor, we are not going to eliminate them. The total sales for the year and loans between the associate and investor, we don't eliminate those ones. Then there is also another important part, which is this: when you are doing your elimination, unrealized profits and losses resulting from the transaction between investor and the associate should be eliminated only to the extent of the investor's interest in the associate. You don't eliminate the full amount. Remember, in International Financial Reporting Standard 10, we were eliminating the full amount of the unrealized profit. So based on International Accounting Standard 28, we only eliminate to the extent of the investor's interest in the associate, which means if the unrealized profit is 100 and the investor's interest in the associate is 30%, so it means you are only going to eliminate this 30%. That's another key area that you should look at, which means we don't eliminate the full amount. We eliminate only to the extent of the investment in the associate. So that's another key area when you are eliminating that you should look at. Then another key area is only the assets and liabilities of the investor are included in the consolidation statement. You don't combine like what we used to do when we say A plus B. Here you only take the assets and liabilities of the investor. The rest for the associate is going to be represented in one line item under investment in associate. So which means what you take to the statement of financial position is this one line item. You take it to the statement of financial position, meaning to say you need to calculate this investment in associate before you do your statements. Then you take this investment in associate to the statement of financial position. So the only assets that we are going to see are those for the investor. Then for the associate, we only have this one line item, investment in associate. The same applies when you do your profit and loss. You are not going to include everything for the associate. You only need one line item for share of profit in associate. So which means you should also calculate this. So in your questions, in your answering, you should have a calculation for the investment in associate and the share of profit in associate and the goodwill and gain on bargain purchase. So that when you do your consolidation, you just check those figures to the appropriate statements. So that's basically two very important aspects that you should look at when you are doing your AIS 28. So which means we don't eliminate everything. We only eliminate to the extent of the investment in the associate. We don't combine assets. It's only the assets for the investor that you take to the statement. The ones for the associate is going to be represented in the investment in associate, which means your calculation that you do here and the investment in associate is the one that you take. So which means you take this step to calculate your investment in associate. Then the final figure that you get is the one that you take to the statement of financial position and investment under assets, non-current assets. Goodwill is not going to be separated. Remember, we say goodwill is in here. So you don't need to separate it. You take only this figure. The goodwill is here. Remember, when you start your calculation, you start by the cost of the investment, which means that goodwill already is here in this cost of the investment. So there is no need to separate it when you go to your investment in the associate. You just start from the cost, then you minus or add anything that can increase or reduce the investment, right? So that's basically the difference between AIS 28 and International Financial Reporting Standard 10. Right, let's look at, this is, we already talked about unrealized profits and losses. They should be eliminated only to the extent of the investor's interest in the associate. You don't eliminate full amounts. You only look at the interest. What is the investor's interest in the associate? Then you eliminate those amounts based on that interest. Let's look at another interesting part here. There's who made profit. This is one of the key areas. Who made profit? Remember, when we were doing our AIS 10, we say only the profit that was made by the subsidiary goes through the analysis of owner's equity. So in your questions, it's very important to quickly determine who made the profit here. So let's look at what they say here. If an investor sells to associate, the investor is the one who sells to the associate. So the investor made profit on the sale of the inventory. Then 100% of the line item of the investor are included in the consolidated statement. This is what we, remember, we check everything for the investor to the statements. The profit that the investor made is eliminated from the revenue and cost of sale line items. You see here, when it is the investor who made the profit, it means our elimination should only affect the revenue and the cost of sale line items. But the inventory is included in the books of the associate at year end. We don't consolidate the inventories, but that inventory that is still being held by the associate, we are going to include it in their books. And the inventory line item of the associate is not included in the consolidated statement of financial position. Remember, we don't include the assets and liabilities of the associate when we do our consolidation. So which means anything that has to do with the inventory of the associate, when we go to the statement of financial position, we are not going to include it. Right, so let's look at what they say here. Investor sales to associate. A Limited is 25% interest in B Limited and has significant influence over B Limited. A Limited sold inventory to B Limited at a profit At year end, B Limited still had inventory amounting to 100,000 on hand. A Limited sells inventory to B Limited at a profit markup of 20% on the selling price. I think this is one I see confusing. There is profit markup on selling price. There is profit on cost. So you should know how to determine the fraction. So this one on markup on selling price is going to be 20 over 100. If it was on cost, it was going to be 20 over 120. So that's the difference. If you don't do this, then it means your calculations will be wrong. So you should look at the profit markup. Is it on selling price or on cost? Right, then they say prepare the pro forma consolidation journal entry for the above transaction. We want to prepare the pro forma consolidation journal entry. I think you guys from your previous consolidation, we should see what is happening here. A Limited is 25%. The only thing that has changed here is this. We only eliminate to the extent of the investment in the associate, but the elimination is still the same. Nothing has changed, which means your elimination journals are still going to be the same. So let's look at the journal that we are going to have in this transaction. Right, we want to eliminate, because you can see here, A Limited sold inventory to B Limited at a profit. At year end, B Limited still had inventory amounting to 100,000 on hand. A Limited sells inventory to B Limited at a profit markup of 20%. So this inventory, there is unrealized profit. Remember in our International Financial Reporting Standard 10, we say if there is an intra-group transaction, then if the inventory is still being under the hands of one member of the group, we call it the profit is not yet realized. The profit can only be realized when the inventory has been sold to third parties. So which means in this case, the inventory that is still there is unrealized profit in that inventory. So we have to eliminate the unrealized profit. So what is going to be our elimination journal? In determining your elimination journals, here you should look at who made the profit. In our case, who is it, the associate or the investor who made the profit here?
Investor.
The investor is the one who made the profit. So if you go back to, so which means we are going to have the double entry that we are going to have is what? Anyone who can determine the double entry. We want to eliminate the profit there. What is going to be the double entry?
Cost of sales.
What do we do with cost of sale? Debt, credit. We want to eliminate.
We debit the cost of sales because we want to reduce the profit.
And then
credit
okay.
the inventory.
Okay, so which means we are going to debt cost of sale. Cost of sale for who?
cost of sale for the investor, which is A Limited.
A Limited is the investor, and yeah, we want to reduce. So we're going to A Limited, right? Then you say we are also going to credit who? Inventory. Who is holding the inventory here? Is B Limited, ne?
B Limited, yes.
Right. So now that the only change that you should look there is, remember we say we don't take into account the assets and liabilities for the subsidiary. So which means instead of your inventory here, you are going to say investment in associate. Right? That is B Limited. So with how much now is what we need next? How much are we going to, how do we calculate is 100,000. Remember I said I want you guys to take note of this part. Profit markup, is it on selling price or on cost? If it is on selling price, 20 over 100. If it is on cost, 20 over 120. Okay, so in our case, it's on selling price, which is going to be 20 over 100 times 100,000 times what? Remember, we only eliminate to the extent of the investment in the associate. So it's going to be times 25%. Don't forget this when you are doing AIS. AIS 28. We only eliminate to the extent of the investment in the associate. Right, so how much are we going to eliminate there?
5,000.
So we're going to eliminate 5,000. We're going to eliminate 5,000. Then the tax effect, we reduce profit here. So our tax, the double entry for tax effect is going to be what? I want you guys to understand this double entry. We reduce profit here by 5,000. So what is going to be the tax effect here? The double
Tax is going to reduce also.
Yeah, we reduce tax as well. So which means you remember in tax we have deferred tax liability and deferred tax asset, right? So in this case, since the tax is gone down, it means we don't have a liability here in terms of tax. It's going to be a deferred tax asset. It's going to be a deferred tax asset in the statement of financial position. And who else here? What's the double entry? What happened to this deferred? How is it going to affect our income tax, this deferred tax asset?
It's going to reduce the income tax.
So which means
which
means we credit income tax in the profit and loss. So that's how we determine it, you know. So it's going to be 5,000 times, let's just use the rate which is there, times 28%. How much is going to be tax? 1,400. We should understand these journals It's very important. Remember, I always say accounting is all about journals. There is nothing in account except do journal entry. So here, when you do your journal for tax, you should look at what happened here. There was a decrease in a profit. So a decrease in a profit also means a decrease in tax. So if a tax decrease, it means you are now going to have an asset. SARS is owing you. You have a reserve that SARS is owing you here. So that one is going to be a deferred tax asset. And you are going to reduce your income tax expense by the same amount of your deferred tax. So that's what this double entry means. So if it was a deferred tax liability, then it means it was going to be vice versa. We are owing SARS. So we are going to increase, it's going to increase our income tax. So we debt income tax in the profit and loss, and then we take the deferred tax liability to the statement of financial position. So that's how you determine your journal entries, right? So that's there. Then let's look at associate sale to investor. When remember they were dealing with an associate sale to investor, sale to associate. Here we're dealing with associate sale to investor, right? The profit is made by the what? By the associate. He's the one who is going to make the profit. The investor's share of profit and losses in associate are included as one line item in the consolidated statement of profit. This is where we call share of profit in associate. So this is the one line item that that represent the investor's share of profit and losses in associate. So you will have a share of profit in associate. This is the one that you take to when you do your profit and loss, which means for the associate, you only need to take the share of profit in associate. Right? Here, the investor is the one who associate sales to the investor. So the investor is the one who is holding the inventory. So which means the inventory is included in the books of the investor. What it means when you do your elimination now, you need also to take note to adjust the inventory in your statement of financial position. Why? Because this inventory is in the hands of the investor. So since the investor is the one who is holding the inventory, you should also adjust this inventory line item in the statement of financial position. If it is the associate who is holding the inventory, we don't adjust this line item in the statement of financial position. Why don't we adjust this line item in the statement of financial position for if the inventory is being held by the associate? Anyone who picks from who understood something from what we have been saying? What I'm asking is, if we have unrealized profit in closing inventory, and in this case, associate sell to investor, which means the investor is the one who is holding the inventory. So when we go to the statement of financial position, it also means we need to adjust the line item of the inventory in the statement of financial position. So my question is, why are we not adjusting the line item of the inventory if the associate is the one who is holding the inventory?
It's because we don't add the assets when we are consolidating. So,
Yes.
yeah,
So the assets for which are only going to be carried to the statements are only for the investor. So since now this inventory is under the associate, so there is no need for you to go now and adjust the inventory in the statement of financial position. So that's another key thing which you should look at when you are answering a question. Who sell to who made profit? So that you know when you do your adjustment. In this case, the associate sell to the investor. So the investor is the one who is holding the inventory here. So which means when you go to your statement of financial position, you should also adjust the inventory line item with the unrealized profit. So that's there. Let's check if there is anything there. This is always assets and liabilities of the investor. All the assets and liabilities of the investor are included in the consolidated statement of financial position. All the assets and liability, the ones for the associate, remember we say, you take all the assets and liabilities of the investor. Then the one for the associate, that one line item of investment in associate is the one that is going to represent everything for the associate. So the investment in associate is the one that is going to represent everything for the associate. Let's quickly look at this small example and see if we are getting there. Like they say A Limited is a 25% interest in B Limited and a significant influence over B Limited. This significance, in most cases, they will tell you in your questions. So you don't need to, what is important for you, especially at this stage, is once there is significance influence, it means you use the equity method. So what you should understand more here is the equity method. Remember, we have the equity method and the acquisition method. So based on AIS 28, we are going to have the equity method. Right, so they say B Limited sold inventory to A Limited at a profit of 20,000. At year end, A Limited still had this inventory on hand. Right, this is the associate who sold to the investor. So which means here inventory, we are going to talk about it in our journal here. We are going to talk about the journal, the inventory in our journal, because the investor is the one who is holding the inventory. So let's see how do we do our journal entry. The most important thing in journal entry is to determine the double entry. That's the only thing. Once you know how to determine your double entry, nothing else is going to stop you from doing the right thing. So what is important in journal entry is your double entry. Here we want to eliminate the profit that was made by the associate. Which two accounts are going to be affected?
cost of sales of the associate,
Cost of sale Are we going to call it a cost of sale? Based on AIS 28.
No, we call it investment what?
Share of profit in associate. This is a profit now. Ne? So we're going to reduce the share of profit in associate. We reduce it by that amount, then we have inventory. By how much? I think the amount is going to be easy. The profit is 20,000. Remember, based on the equity method, we say we only eliminate to the extent of the investment. Don't forget that line for the equity method. We only eliminate to the extent of the investment. So which means our elimination is going to be 20,000 times 25%. Am I right? Yes. 20,000. 25% is the investment. So we eliminate only to the extent of the investment in the associate. So we're going to eliminate 5,000 here. Right? So when we go to the statement of financial position, since the inventory is under the investor, we need to go and adjust again the inventory line item. The tax effect, is it not the same like what we did? What is going to be the tax effect? I think it's now easy now. The tax effect is going to affect what? We're going to have a decrease in profit and a decrease in tax, which is going to be deferred tax. Here we are dealing with an associate who is having the profit. So it's no more going to be income tax. Remember, we don't take the income tax expenses for the associate to the consolidated statement. So which means it's only going to affect the share of profit in associate. By 5,000 times 28%, I think we did this, it's 1,400. 1,400. Right. So that's how you do your tax journal. Unless if there is anyone with a question, I want us to do a question. We can finish. We still have 1 hour. I think we can be able to finish the question. Unless there is questions, we can do this long question together and see how you guys grasp this topic. So let's quickly go through this question together. They say the following represents the trial balance of Stereo Limited and Sound Limited for the year ended 30 June 2016. This is usual. We always do see these things. But where you should look, where there might be a difference is, they say on 1 July 2013, Stereo Limited acquired 8,100 ordinary shares of 15,400 in Sound Limited, a company in the motor industry, when the retained earning of Sound Limited amount to 8,000. Stereo Limited exercise significant influence over the financial and operational policy decision of Sound Limited. the published market price of the investment in Sound Limited was 16,000. So which means in number one, you have your share capital and retained earning, and you also need to calculate the percentage of interest here. You need the percentage of interest on note number one. Then let's check on note number two. At acquisition date, no unidentified assets, liabilities, or contingent liability existed, and the fair value of all assets and liabilities was confirmed to be equal to the carrying amount. Then number three, during the current financial year, Stereo Limited bought inventory from Sound Limited at a cost plus 20%. You see, this one is cost plus. At year end on 30 June 2016, Stereo Limited had inventory amounting to 5,700 on hand that had been bought from Sound Limited. Here you should look at who made profit, who sold to who is still holding the inventory. So here we're looking at Stereo Limited bought inventory from Sound Limited. So let's see who is Sound Limited. Okay, so Sound Limited is the one who made profit, and Stereo Limited is the one who is holding the inventory. So which means when you go to adjust your statement of financial position under the inventory, don't forget to adjust them and realize profit in the inventory of the Stereo Limited group. Right, then the South African normal tax rate has been, we can use that one. The equity investment is measured at fair value through profit and loss. The fair value of the equity investment is equal to the original cost price. So we already have our cost price of the investment. That's the fair value of the investment. The Sound Limited group accounts for investment in associate using equity method in accordance with AIS 28, investment in associate and joint venture. You'll see our next topic is going to be joint ventures. You'll see that it's more or less the same. They use the same standard, but in joint venture we use 11 and 28. Right, so they say Sound Limited is incorporated in South Africa and its principal place of business is in Durban. Sound Limited produce inventory used in the operational process of Stereo Limited. Each share carries one vote. I think there are theory questions. We will not have time for the theory question. I want us to see the calculations. Where are the calculations? Right, let's do D. Because of time, I think we should prepare the annual financial statement of the Stereo Limited Group for the year ended 30 June 2016. The financial statements for the Stereo Limited Group. Right, where do we start when we have this kind of a question? Where are we going to start? Where do we start? Where do we start?
I think we need to start with the initial recognition.
Yeah, the investment in. Are we gonna use the analysis? What happened to my? Yeah. Are we going to use the analysis here?
No.
Which one do you think we should use? We can use the analysis, we cannot use the analysis, but for the sake of there is goodwill in our calculation, I think we can use the analysis. because we want to calculate goodwill or gain on bargain purchase, or we can use our method. Let's use the method that we have shown there. So which means we need to calculate if there is goodwill, right? That's the first thing. But the first thing is to determine the percentage of interest. So our percentage of interest is going to be 8,100 over 15,400. It's going to be how much there?
I'm getting 53%.
Okay. Once here they say Stereo Limited, no, we don't use, you see where, these are not shares. Am I right?
Those are runs.
Yeah. Where are the shares? The shares are here. So you use 18. You see another trick. You will now be using the wrong things everywhere. So this one is going to be 18,000. So we're going to have 45%. Ne? That's the percentage of interest. Are we together on this? So don't confuse and use and mix runs with number of shares. When you are calculating the percentage of interest, you always use shares, number of shares, which means number of shares acquired over total number of shares. Then it is going to give you the percentage of interest. Then when you have your percentage of interest, you can now be able to calculate the goodwill. So let's calculate the goodwill. Let's do our calculation here. Let's use that method for calculating goodwill without using the analysis. Or you guys, you prefer the analysis? What can we use here? The analysis or the shortcut?
The shortcut, because the analysis is too long.
Yeah, it takes your time in the exam. It takes your time. And sometimes you'll see that it will take your time and you only need maybe goodwill from the analysis. Okay, so let's look, especially investment in associate. So what you look at is when you are calculating, so it means you need your share capital. You need your retained earning. What else do we need in our calculation? Let's see. We need the retained earning was 8,000, and the share capital, where's the share capital, is 36,000. So what else do we need? I think that's all. We don't have any revaluations, anything. So that's all there. So we have share capital of 36,000 here. Then retained earning of how much? 8,000 here. How much are we going to have all together? It's going to be 44,000. When we have the 44,000, what are we going to do? from our previous calculation. Anyone who can still remember from our previous calculation?
Don't you multiply with interest?
So this is going to be the net asset value, ne? Yes, net asset value. Then what you say you are going to multiply. So interest, percentage of interest is 45. So which is going to be 45% times 44,000. How much are we going to have there? $19,800. Am I right? This is the percentage of
Yeah.
interest.
Correct.
Then we have our cost price of the investment. The cost of price of the investment is 15,400, if I'm not mistaken. For 15,400 in Sound Limited. So this is the cost price of the investment, 15,400. $15,400. What are we going to have here? Before we even calculate, what are we going to have? This is the cost price of the investment, and this is the equity. So what are we going to have here?
Again on again on what?
Then on bargain purchase, ne?
Yes.
Of how much? It's going to be 400 here, 4,400. So that is going to be the gain on bargain purchase. We don't have goodwill in this. We have a gain on bargain purchase. So you will be done with your calculation for goodwill. Remember, we want to do the profit and loss and the statement of financial position, the statement of change in equity. So we need to determine also the investment in the associate. We need to determine what is the investment in the associate. So let's also do another calculation for investment. Investment in associate. Right. So in your investment in associate, we already have our, remember if you go to the notes, we start from the cost of the investment. The cost of the investment is 15,400. Then we add or subtract anything that is going to reduce the cost of the investment. This investment in associate, remember, is the one that we take to the statement of financial position under the investment in associate line, non-current asset. So we need this line. So let's calculate the investment in associate. So we start with the cost of the investment, which is 15,400. Then anything that is going to increase or decrease your investment in associate, you take it here. Anything that is going to increase or decrease. So let's start from here. Let's start with this, what we have here. We already have gain on bargain purchase. So the gain on bargain purchase of 4,400. So it's going to increase our investment. It's an excess. So it's a gain. So it's going to increase our investment. Then let's look for anything that needs to be calculated. What you can look, remember they say you need to look for anything that decrease or increase. So let's start from the retained earning. Since acquisition to the beginning of the current year, what happened since acquisition to the beginning of the current year? Do you see here we have a loss here? We have a loss there of 14,400. That's what happened since acquisition to the beginning of the current year. And the retained earning at acquisition was 8,000. So we need to account for that loss. So we are going to have the accumulated loss minus 14,500 minus 8,000. How much are we going to have? Are you guys there? How much are we going to have there? 22,000 times 45%. So it's going to be how much all in all? Are you guys there or am I alone now?
925.
So it's going to be how much? So this one is going to be 22,500. Then you multiply it by 45. I got here 10,125. So this one is a loss. Remember we say we increase or decrease the investment by any profit or loss. So this is a loss. So we're going to decrease the investment by that amount. Right, when we have that amount, then we go to anything that can decrease this amount. What are we going to do? Who made profit here? So which means we are going to look at the profit for the year. They have to share the profit for the year. So we need to calculate the profit for the year for the subsidiary. Remember, they share the profit for the subsidiary. So there is revenue of 100,000 here. Income tax of 8,100. Where is the cost of sale? Cost of sale of 68,000. So they have to share this revenue. So it's going to be 100 minus 68 minus 8,100. So here it's going to be a share of profit. It's going to be 100,000 minus 68,000, the cost of sale. Minus 8,100. Do we have other incomes? If there is any other incomes there, we can take the other incomes. Plus other incomes of 5,500. Times, don't forget the percent, 45%. So how much are we going to have all in all? The one that is going to be the share of profit.
I got 13,230.
Are we guys together on this thing, or there's a bit of confusion?
230.
Yeah. So this is going to be the share of profit. Then we also need to eliminate the dividends. We check if there was any dividends that were paid by the associate to the group. They paid 12,000. These are the dividends which were paid by the associate. So we need to eliminate those dividends by the percentage of interest. So we have dividends. So it's going to be 12,000 times 45%. How much are we going to have there? Times 45%, 5,400. This one is elimination. Then we have our investment in associate. So let's start to add and subtract from the top, which means we are going to have 15,400 plus 4,400 minus 10,125 plus 13,230 minus 5,400. So the investment in the associate is going to be 17,505. So this is going to be your investment in the associate. Then when you have this calculation, the next thing that the last calculation that you need now is the share of profit. So this is going to be your C3, share of profit So this is going to be your last calculation. You need the share of profit in associate. Where do we start with the share of profit? Which means we just need the profit. What was the profit that was made? Then we share that profit. So which means we have now here, let me just go back to the question. It's something that right here they say during the current financial year, Stereo Limited bought inventory from Sound Limited. Right, this is another key area that you guys must check. So which means you only adjust when you are calculating the share of profit, because who made profit here is Sound Limited. So the share of profit is for Sound Limited. So which means you are going to make an adjustment for tax and other things when you are calculating the share of profit for Sound Limited. So which means here, we need to adjust what we already have here. We have the share of profit, which is already this 13,000. You can recalculate, but we have already calculated. then you need to apply the tax effect. You need to apply the tax effect. So which means you come here. During the current financial year, Stereo Limited bought inventory from Sound Limited at a cost of 20%, at a cost plus 20%. At year end on 30, Stereo had inventory. So here we're going to have 5,700 times 20 over what? Cost plus over 120 ne? Times 45%. Am I right? So here we're going to eliminate unrealized profit. So the unrealized profit is going to be 20 over 120 times 5,700 times 45%. How much are we going to have as our unrealized profit there? You can round it to 428, am I right?
Yes.
So this is our unrealized profit. Then tax on unrealized profit is going, let's use the 28 which they use there. It's going to be 428 times 28%. Then how much are we going to have there?
120.
What are we going to do with the 120? Add or subtract?
Subtract.
Is it going to be subtracted? Is it going to increase our profit or decrease our profit?
It's going to increase our profit.
So we don't subtract it. So
Yeah,
let's come up with the final share of profit in associate. Which means it's going to be 13,230 minus 428 plus 120, 12,922. So this is our share of profit. You'll be done with your calculation for everything. So the next thing that you need now is to do the profit and loss for the Stereo Limited group. So you need to do now the profit and loss, statement of profit or a loss. Right, so we need what there? So which means we just come here and look for, remember here the equity method says the line item for the associate is only going to be the share of profit in the associate. So which means what we take now is going to be for the investor. So we need to determine the profit for the investor here. So we're going to have the revenue for 220. Other incomes are not there. there's dividends received. Dividends received of 11,500. Okay. Then what else to get to the profit? We have the cost of sale, then the income tax expense. But income tax, we can take it as a separate line item. So which means we just need the gross profit, which is going to be revenue 220 minus cost of sale. So we are going to have a revenue which is 220 How much are we going to have as our, sorry, let me put it, you see now, it's going to be revenue 220,000, then cost of sale, it's 147,000. Then our gross profit is going to be how much there? Yes. I'm waiting.
73,000.
Let me just check if we are checking the right figure. Oh, it's 47,800 on cost of sale. So the cost of sale is 47,800, yeah? Minus 147, 72,200, that's our gross profit. Then we have other incomes. Under other incomes, we go and look for other incomes. Other incomes is going to be, we only take for the parent, for the associate. So we are having dividends here, 11,500. These are the dividends that we received. But we should not forget to eliminate them, the one that was received from the associate. So which means we are going to have 11,500 minus 12,000 times 45%, which is going to be 5,400. We have already calculated this one. So how much is going to be our other incomes here? We just subtract 11,500 minus 5,400 is going to be 6,100. So this one is going to be 6,100 other income. It's going to increase. Then you go to your calculation and take now your share of profit in associate. Which is your calculation 3. I think we did this one in our calculation 3, which is 12,922. 12,922. It's going to be 12,922. Then you have your profit before tax. Okay, so we start from here. We can add here, here, and here. So our profit before tax is going to be 91,
21,222.
right? Then we need the tax. The tax line item is only for so income tax. If you had, let's say, if the investor is the one who would have made a profit and you have adjusted the tax, then it means here you should adjust tax under this line item. But in our question is the associate who made the profit. So there is no need for you to adjust the tax line item. So you just take the one for the investor, the tax for the investor, which is going to be 20,600. So it's going to be 20,600. So that's the tax. Then we need the profit for the year. So we're going to need the profit for the year, which is 91,222 minus 20,600. So the profit for the year is going to be 76,222. That is going to be the profit for the year. You don't have to share. Remember, in AIS, International Financial Reporting Standard 10, we share between NCI. Here there is no share. The one for the associate, everything for the associate is here. That's what represents everything for the associate. Right, so that's the statement of profit and loss. I don't know if there's anyone with a question. I want to show you how you do your statement of financial position based on the information that we have. I think we still have 20 minutes. Anyone with a question before we? Right, when you go to your statement of financial position now, so you're going to have your Sound Limited Group. I will only take where there is adjustments here. Right, so let's look at what you take to the statement of financial position here. So we have our assets, non-current assets, right, under non-current assets, we are going to have PPE. There is no adjustment for PPE here. We take the one, remember we say we only take the one for the investor. So there is no adjustment. So you just come and take 323 600. So it's going to be PPE is 323 600. Then you should also look at investment in associate. The investment in associate, you did it in your calculation 1, that is your C1. So you take the investment in your associate, which is 17,505. That's the investment in the associate. Then what else? We had the deferred tax asset here. So we need also to take it here. Deferred tax at 120. Right, then we have your assets. We'll have your total non-current assets. Then you go to your non-current assets. The only line item that you are going to change under non-current assets, under current assets, is the inventory. So which means you need to take out that unrealized profit. You need to take out that unrealized profit, which is going to be under inventory. You are going to take out the unrealized profit. Let's go to the inventory. The inventory line item you only take for the investor, which is 21,900 minus the unrealized profit. So you need to minus the unrealized profit, which is 428. The one that we did the calculation, we say 20 over 120 times 5,700 times 45%. So this is the only line. The reason being that this inventory is still being held by the parent, by the investor. So you remember we say we only take assets and liabilities of the investor to the statement of financial position. So which means since this inventory is still held by the investor, then we need to adjust them and realize profit in it. So under your inventories, you are only your non-current assets, you are only going to adjust the inventory there. Right, then you have your total assets. You'll have your total assets here. Then you will be done with the non-current asset. When you go to equity and liability, there is nothing that you are going to change there. We don't have NCI. We don't take, so which means equity and liabilities, you only take those for the investor. The equity and liabilities for the investor. So it is going to be a copy and paste. You just go and take the one for the investor, which is going to be the share capital and the retained earning. And You got current liabilities. Trade and other payables. Then you have, so which means what is important is only the adjustment that you are going to make under the inventory, and also the carrying of the investment in the associate to the statement of financial position. Right. What else is here? So we're done with the profit and loss and the statement of financial position. What else is part of financial statements? So which means here we'll be done with yeah. So here, if you want to do the analysis, you can do. You take this information that you use here, then also this information, some of it can go to the analysis, the one for the investment in the associate. I don't know if there's anyone with a question before we close the class. I can see people are tired today. Any question before we close the class?
Yeah, I just want you to elaborate on that income tax. How do we treat it when you explained a little bit there, because there is a difference the way we treat it when the profit is from the associate, or the profit is on the investor. So I just want to know the difference there on the income tax, or if there is deferred tax when there is unrealized profit there.
Okay, you are here on income tax.
Yes.
Okay, right. So what happens here is, the first thing that you do is you look at who made the profit here. So in our case, we have during the current financial year, Stereo Limited bought inventory from Sound Limited. Stereo Limited bought inventory from Sound Limited. You see that one? So Stereo Limited is the one, Sound Limited is the one who made the what? Are we together until here? Is the one who made profit. Right? Are we together until here, where we still, Sound Limited is the one who made profit. So what I was saying is, when you are here on your checks, if the associate, the investor is the one who had made a profit. Remember, we take this for the line item for assets, for expenses, we take the one for the investor. So what it means, if the investor is the one who would have made a profit, then it means this income tax, we're going to adjust it. But now, in our case, because the associate is the one who made the profit, we only have to adjust it under the calculation from share of profit in associate. We don't bring it here. We only do it in the calculation from the share of profit in the associate, because the associate is the one who made the profit. But if it was the investor who made the profit, then it means we're going to adjust this, because we take all line items for the investor in the profit and loss and the assets and liabilities. So that's basically the difference. So which means here you look at who made the profit. If the investor is the one who made the profit, then it means you need to adjust this line item for income tax by the amount of tax that is going to reduce the tax or increase the tax. So that's basically the difference between AIS 28 and International Financial Reporting Standard 10. Right? I don't know if I'm on the point or I'm missing something. Are you getting what I'm trying to say?
Yeah, it's understood.
Yeah, that's basically you just look at who made profit. So if the subsidiary, the associate is the one who made profit, there is no need for you to go and adjust the tax effect in the consolidated profit and loss, because we say we only take line items of the investor to the profit and loss. 100% line items of the investor are taken to the profit and loss, to the statement of financial position. So if he is the one who made the profit, then it means we need to adjust the tax effect in the profit and loss. But if not, then the tax effect is only going to be adjusted in the calculation for the share of profit in the associate. So that's basically there. Unless if there's anyone with another question, I think for today we're done. I'll send another question for this topic. I want you guys to try and look at it as individuals and see how you go. Then our next topic is going to be easy, because it's more or less we'll be using the equity method, but we'll be doing investment in joint venture, but it's still going to be the equity method. So I'll send another question so that you guys, you can try and see how you can be able to understand based on what we have done together. Okay. Okay, good. I'm gonna close the class. Thank you everyone for attending the class.
Thank you, sir.